me today is Sunil Singhania, the founder of Abakkus, Vaibhav Chugh, the CEO, and Pratish Krishnan, Senior Fund Manager Equity, to talk through the fund's philosophy, its differentiation in a very crowded large and mid-cap category, and where they see the markets headed from here. Gentlemen, hi, afternoon. Sunil, congratulations for this new launch, but one would wonder why launch a large and mid-cap mutual fund now, and why this category feels right as an entry point into the retail mutual fund business.
Thank you, Aisha, for having us, and thanks for all the wishes always for Abakkus. I think you're right. Obviously, we have quite a few really good funds in this category in India, and to that extent, why this category and why one more. So very clearly, I always say this, that the first $1 trillion of India's economy was contributed by very traditional sectors, the old PSU banks, metals and steel, and at that time it used to be tea and jute and cotton textiles. 1 trillion to 4 trillion, we had IT services, pharma, a lot of consumption names coming in, private sector banks. And now when we move from 4 trillion to 8 trillion, this is going to be a combination of some of these old traditional sectors, but a lot of new categories. Even in the consumption place, there will be new categories, some new age businesses, engineering and so on, consumption and so on and so forth. And I think looking at all this, our view was that, rather than just focusing on the larger companies, I think investors will have to branch out towards having a basket which is a little bit more broad-based. Obviously why not only mid-cap? The mid-cap segment, as per the regulator's definition, comprises of 150 companies, and I think that space to some extent is becoming a little bit difficult because too much money is flowing in to invest only in these 150 companies. And I think by having this kind of a diversified sort of option to invest, we feel it would be more beneficial for the investors. Why equity now? I think we are positive. You rightly mentioned oil from high of $126 had come down to 70. In the interim, it's moved up to 85. But our view, and we have shared it multiple times, is that structurally oil looks very weak, and we should be looking at oil, significantly lower than what it is today over the medium to long term. Also, the economy is chugging off well. We have seen great GDP numbers in December and March. We are seeing great numbers in terms of tax collection, what has been reported over the last couple of days. And corporate profit growth is also inched up. So I think it's a good time for the underperformance of India over the last 1.5 years to be made good. And with that in mind, I think this new fund offering has been presented by us to investors.
Vaibhav, I want you to add to that. As the CEO, tell me what will be the operating philosophy right now for this particular scheme at Abakkus MF, and how would it differentiate itself in terms of risk management, liquidity, investor communication, etc.?
Sure. So thank you, Aisha, for having us. See, in terms of product positioning per se, so if you look at the category in itself is about 3.5 lakh crore in terms of AUM, and very stable in terms of flows. And our sense is that this is one product which is like a solution for investors who are looking for a relatively lower volatility in their portfolios, but then better alpha than say a pure large cap fund. So the positioning of the fund is very clear that the mandate is to invest 35% in minimum in large cap, 35 minimum in mid cap, and remaining 30% will be the prerogative of the fund manager, and he can manage it dynamically. But I think if you look at the data for last 10 odd years, the standard deviation of large and mid cap is in line with large cap fund, but then alpha has been better than pure large cap plays. The second part of your question in terms of how are we going to manage, see, at Abakkus we are governed by our philosophy and our framework. And that has been in existence for last 8 years from the time Abakkus has been in existence. And that 8 years has, that 8 years reflects, how the framework has worked. So we have our internal framework called MEETS, management, events, and trend, earnings, timing, and structural. So this framework, of course, Sunil sir and Pratish, they can elude upon this particular framework in detail, but this particular governing framework has been in existence for last 8 years, and we abide by this particular philosophies and frameworks even for this fund. See, for us, the way we look at stocks, the way we look at stock picking per se, that does not change. It's only that the framework for this particular fund will be different, but then the guiding framework of investing, picking up stocks or sectors, that remains same.
Right. Pratish, add to that, because, what the portfolio construction is going to be is the key question. What Vaibhav was just talking about. Traditionally, one is very tuned to think that alpha generation happens maximum in the mid and the small cap spaces. So tell me, for this particular scheme, what's going to be the split between large and mid cap exposure as you see it right now, and how much flexibility would you have to try and shift that proportion?
Sure. No, fine enough. So what we said is this category, at least 35% has to be large caps. We are kind of positioning these as, large cap being in the range of like 35 to 45%. At this point of time, we are working with around like 42% weightage on the large cap side, around 45% weightage on the mid cap side, and probably around like 14, 15 on the small cap side. That's the broader construction. See, our sense is if we are like invested 70% in the large and mid cap, at least 30% is the tactical allocation, and we'll kind of, evaluate in terms of probably a higher small cap exposure at some point of time. So we would want to retain that flexibility on the small cap side for this portfolio.
Sunil, you've been the Nostradamus in that sense. You said it's time to now buy small caps, and you said that the market correction is behind us, and bang, you had the Nifty make a bottom. You were so right about oil prices as well. And, that's really played out beautifully. But you've also spoken always about buying quality businesses at the reasonable valuations. After the sharp correction that played out up until March, we've not done badly. At an index level alone, we've managed to eke out about 8% of a rebound from there. It's been even better for mid and especially small caps. So one would wonder why large and mid caps when the better performing segment has been small caps, and you're a small cap maverick in that sense any which way. Do you think that large and mid caps are offering a better risk reward right now?
So I think you're right. So, we launched a flexi cap fund, which was the first fund, which gave us complete flexibility. We launched a small cap fund bang in the middle of the Iran war, and the timing has been perfect. I think in the last 3 months, that fund in absolute basis has returned quite a decent thing. But see, from an investor's perspective, investors have to have one, diversification, and second, they should also have the choice. Now, obviously, if you are an investor who's investing from 5-10 years perspective and you don't get rattled by the sharp volatility which has become the order of the day. Earlier this 15-20% move in the market used to happen once in 3-4 years. Now they happen 3-4 times a year. So if you are willing to stomach that, then obviously your weightage has to be more towards small cap. But I think what this fund brings in, as Vaibhav also mentioned, that it reduces the volatility significantly. At the same time, it provides you an opportunity to create alpha with your mid-cap exposure to the extent of 35-40%, as Pratish mentioned, and also the small cap, which would be right now around 15-18%. So it's more for investors who don't want too much volatility in their portfolio and also want a diversification away from a pure small cap fund. But as you rightly said, India is a country of entrepreneurs. India is a country of growth. And the way we are living is changing quite dynamically. And I mentioned to you earlier also. So we were just discussing, like, say earlier consumption used to be toothpaste and soaps and shampoos and so on and so forth. Now consumption is more Alcobev and more the QSR and so many other things, more beauty products and so on and so forth. And companies in that segment necessarily are small to mid. Or even if you look at financial services, earlier it used to be only large banks. Now you have niche NBFCs, you have asset management plays, wealth management plays, you have broking companies, you have, capital market plays. There also most of the companies are in the mid to small side. So, to capture some of these new businesses, you have to have a diversification in the portfolio. At the same time, having 100% in small cap will lead to huge volatility. So this is another option for the investor to sort of balance, volatility at the portfolio level at their end.
Would you say, though, Sunil, that the best of the gains for small caps are behind us for this year?
No, I don't think so. I think every time we feel that and the market brings a surprise, yes, from March lows, stocks have rebounded. And I think that again is a lesson that if you miss that 1.5 months, maybe your 1 year returns will go down. I think we have been lucky in our calls. I think our call on IT services, our call on oil has played out pretty well. We are now basically very clear that the FI flows will also come in, and that should basically make the markets a little bit more balanced. So last couple of years, FI flows were negative, so the large caps bore the brunt of it. And that's why the difference in performance of large vis-a-vis mid and small was quite big. I think even now we are quite confident that mid and small will outperform, but the difference in the return vis-a-vis large might not be as startling, because when foreign flows start to come in, even large caps move up in sync.
So, Pratish, elaborate a little bit more on what Sunil said. He was talking about engineering and, of course, a lot of, other segments when it comes to the mid and small caps. But particularly, let's pick up on large caps. What could be the sectoral, composition like? And which are the sectors within large caps specifically where you're most convicted on right now? Which ones are you deliberately staying cautious on, given the current valuations?
No, sure. I think that's a fairly valid question. So if you look at, very clearly, financials stands out for us from a sectoral perspective. And this has got, even large private banks, for example, and even large NBFCs, right? I think this is one sector where you're seeing the credit growth numbers. They're fairly strong, almost like 17% growth for this last month. I think even in normalized growth of 14-15% is very healthy. We have been through a phase of names compression and probably will see the bottom somewhere at this point of time. So in that sense, large private banks, large NBFCs makes a lot of sense today from a financials perspective. Similarly, if you look at IT services, there are large names out there, but as a house, we have been negative in the IT services segment. So this is one sector where we are underweight from a portfolio perspective. So for us, sectorally, financials, consumer discretionary, healthcare, these are like sectors to kind of look at and very interesting. And sectors to avoid probably will be the IT services kind of names.
Sunil, the other thing that comes to one's mind is that do you bet on the index composites now? And specifically, let's talk about the large cap pool. Or do you bet on what the index will look like in next 5 years from now? The sectors that you were talking about, the changing face of NBFC, the changing face of how we consume and what we consume right now. Stick your neck out. What do you think the index is going to look like 5 years from now?
No, I think exactly you hit what we also believe in. So I mentioned to you that this 4 to 8 trillion will be contributed by some sectors which are existing, but a lot of them would be newer sectors. Now, the way the Nifty is composed, it's a market to cap weight indices, and unless you reach a particular size of market cap, you don't come into the Nifty. And therefore, if you see the Nifty, it comprises a lot of good companies, but companies whose growth rates are well behind their peak, in the recent past. And therefore, again, if you see the numbers, corporate profit numbers for December and March, the Nifty earnings growth was sub 10%, whereas the broader market earnings growth was upwards of 15-20% in some cases. And even in June, I think the outlook is similar, that Nifty earnings growth might be more like mid to high single digits, but overall the markets will report a healthy 15 to 17% profit growth, because the growth sectors are now outside of Nifty. And therefore it would obviously make a lot of sense to look beyond Nifty, and that is the reason why we have this fund and also the other funds. So if you look at financials, for example, earlier financials used to be the top 5-6 banks and that was it. Now financials are also some very, very good niche NBFCs. Financials are also now capital market plays. Financials are now asset and wealth management companies. Financials are now life insurance and health insurance companies. And there are a lot of fintech companies also which are coming up, which will also be like the financial, a lot of tech-based broking companies and all. So I think the composition of Nifty will definitely change. It will take a while because, to get into Nifty, you have to have 1.5 lakh, 2 lakh crores of market cap, which will maybe take time. But clearly, if you have to play and if you have to make alpha in India, you have to do what you said, that invest in the Nifty, which would be the Nifty 5-10 years down the line rather than Nifty, which is today.
But talking about the Nifty, which is today, Sunil, and your conviction that FIIs as well will come back to India, even though they're going to be buying India a little bit more expensive than what's perhaps currently available on the ticker, they will have to buy IT, purely because of the large allocation and the weightage that IT as a sector does enjoy. Do you think IT is a contra call right now, purely looking at the prices and the valuations?
Yeah, so based on prices, there can be a bounce, frankly. But, till the growth comes back to at least 8-9%, we don't see any meaningful, outperformance of the sector vis-a-vis the broad markets. The growth rates as guided by the companies themselves is 2-3%. Obviously, the PE multiples, which used to be 30-35, have compressed to 15. But with 2-3% growth, there is not too much of a case for them to outperform. The other thing is, in IT, global investors have a lot of options outside of India. So they don't need to have a weightage in IT in India. If you look at companies like Accenture and Cognizant, which are listed on the US markets, they're trading at multiples which are 50% that of the Indian IT companies. Accenture is at 8p and Cognizant is even lower. Even in India, even now, companies are trading at 15 multiples plus, and some on the mid-cap side are trading at some 25-30p multiples. The other thing is, you're right, when money comes in, global investors will have to buy some larger companies. And Pratish mentioned, some of the sectors where we are positive on, obviously, private banks, which have underperformed, pharma. But the good thing is that earlier, there was a handful of companies which were like $1 billion plus market cap. Now in India, the small cap definition is, upwards of like, the mid cap starts from like $4-5 billion. So there is more than enough options, even beyond the top 50 companies, for global investors to put good money or a good amount of money to work. And I think that is where we already seeing that, and that is where we'll see also.
Pratish, but looking at the market environment right now and the way things change pretty much on an hourly basis, dependent on certain tweets by a certain someone, if we look at this fund a year from now, what would you consider genuine success? Would it be outperformance versus benchmarks versus category peers, or would it simply be capital protection through volatility, the times that we're living in right now?
Yeah, so I think what we're saying is, over the last 2 years, I think markets peaked somewhere in September 24. We have seen, fairly good amount of consolidation in the markets. In the same time frame, I think earnings have clearly kind of, come through, right? I mean, last 3 to 4 quarters, especially, earnings have rebounded. And our sense is, based on whatever the government policies, which is pro-growth, the earnings, there is fairly good confidence that this earnings number can sustain. So in that kind of environment, we believe, the consolidation phase is probably done with. And stock-wise, there are opportunities within this segment, especially in the mid-caps and the large caps, which probably can, offer good returns from here on. So our broader bet is, I think a large consolidation is now done with. Earnings are fairly resilient, and we are in a growth-oriented segment today. And probably it's an opportunity time to kind of look at this space overall.
Sunil, talking about small caps, before we let you go, is there any space which is looking like it's done its bit and it's time to get out right now? Anything which is looking topish?
I think, very frankly, it was much easier to buy in March. It was a buyer's market. There were more sellers than buyers. Now, obviously, there are, I would say, a good amount of buyers also, so it is tough. There are some spaces which are very interesting from a long-term perspective, like I would say, capital goods or, that space. Even on defense, for example, the outlook is very positive, but the stocks have run up pretty fast. So I think what we're trying to do is in these spaces, we're just zeroing down on companies which we like and, waiting for some bad news, either geopolitically or, in terms of some near-term corrections to come in. But small cap is all about individual sort of companies and stocks. Some spaces where we are finding value, I think consumer discretionary, particularly the smaller companies, they have been out of favor for the last 2-3 years, largely because the growth was not there. I think there we are seeing growth come back a little bit, and valuations are significantly in our favor. So some spaces there is opportunity. Some spaces the outlook is great, but the prices are even more great. So there we are waiting.
Tough market to maneuver. But gentlemen, thank you so much for all of your time today. Sunil, Vaibhav, Pratish, great speaking with you and good luck with the fund.
Thank you. Thanks for your wishes.